All right, welcome everybody. Elliot Katz here for the Rich Options Jerk. Got some really cool stuff to share with you today. Uh, got some new positions, some new trades for you guys to look at. Very instructive stuff. Also have some very interesting position management techniques to share with you today. But first, let's just take a look at the market. We are at new all-time highs. After two successive gap opening days, Monday and Tuesday, market was kind of sideways to up for most of the day, and we did close on new highs, which is good to see, given that this is the first full week back and nobody's blowing off any atomic bombs anywhere, and things seem to have kind of settled down in the markets. As far as industry groups go, we're having a continuation of the improvement in the oil patch. If you go through your ETFs and you look at any of your sub-industry ETFs, you're going to see lots and lots of strength here. We do have a Schlumberger trade on, and I am looking for some other trades as well, but things have gotten a little bit ahead of themselves, so I would really like to wait for a little bit of a pullback here. You can go to any stock that's in this group. Let's see, I'll show you. This would be a perfect group right here, this energy sector or this exploration sector, where you've got Schlumberger up here. Okay, we've got the November 67.5 calls. Our net cost is 266. I think they're trading at about $2 right now. So we're going to look to maybe collect some premium in here. It looks like we're going to start hitting some resistance in this area. So wouldn't mind taking some money off the table, get that cost down to even below 266. Maybe over the next couple of weeks we could collect another $1 or so. That would be pretty sweet for us. You go through Halliburton, you go to any of them. Halliburton, oil, National Oil, well, Varco. I've got stocks like CLR, Cabot Oil and Gas on my watch list. So you can go through pretty much any of these groups, and you'll see some pretty good strength here. There's Conoco. It doesn't matter. You go through anything. After that, the financials have really started coming back now that the bond market's been down for a couple of days in a row. Let's see what the bonds were today. Bonds today were down 10 ticks. Certainly a lot better performance than yesterday, but we're seeing big improvement in the financials. In fact, our JP Morgan trade, which we were suffering with on, I think it was yesterday. Let's see. Yeah, yesterday I sold the remaining September 90 calls at $1.20. Now, we had gotten our cost down to $1.74. So, unfortunately, this was our first loss after 11 winners and one scratch trade. But we only lost 54 cents. So that is below, I believe it's below our average gain, which is always a good thing, to keep your average loss below your average gain. And to have, so if you have a high batting average and your average loss is less than your average gain, you should make some decent money over time. And that's exactly what we're trying to do here with these spreads that help us manage the risk as the stock moves through time. Just to give you some history, we started this trade on July 25th with a trade cost of $3.57. Last week, actually week of September 1st, we actually, for the September 8th expiration, last Friday's expiration, we got the cost down to $1.74, and we sold the September 90 call at $1.20. So hence the 54 cents risk. But you could see that we took out $1.80, took out half the risk in a span of a little over a month. which is the smart thing to do. Okay, not so smart thing that I did, although I think in retrospect, we can't do the 2020 hindsight deal. You'll drive yourself crazy. The eBay trade, which we had put on for 84 cents, took it off for $1, and now it looks like it's going to close at its full value at $2. But anyway, that's the way it rolls. So we made about 16 cents on that one. Anyhow, the point being that this JP Morgan trade, this history takes us from a $3.57 initial cost on July 25th to $1.74 cost on September 1st. And even though we got out of the trade at $1.20, that leaves us with a 54-cent loss, which is very minimal relative to where we started. Okay, so just want you guys to keep that in mind, that if you are bringing in premium using the techniques that we talk about in the diagonal spreads, you should be able to help yourself over the long run with that technique. Okay, so let me show you a couple of things that happened over the last few days. And then I'll show you this really, really interesting position management technique in the Celgene trade. So here's Amazon, and you could see, as I've been saying recently, since we started this venture, we haven't really done any meaningful number of credit spreads. We did an IBB put credit spread way back when at the beginning. We collected 90 cents for that. It was a $5 spread, worked out fine. And the other one that we've just done, our second one, is an Amazon trade where back on just Monday, September 11th, we sold the September 962.5 put and bought the 962.5 put. We did that for $1.15 credit. And if you notice, we already have an open P&L of 81.50. Now, the rule of thumb is that you want to start thinking about taking these things off when you've reached about 80% of the profit. Okay? In this trade right now, the stock is almost $1,000. We put this trade on 2 days ago, and I'll show you the chart, and I'll show you why we did this. Okay, but right now you could see that the short put is about $37 out of the money, which is almost 4%, because the stock's almost 1,000. And we have a positive theta of $3. So over the next couple of days, we really should see some additional theta decay. And fortunately for us, we have a very small positive delta. In fact, our delta is smaller than our theta. So what does that mean? Positive delta means that as the stock goes up, right, positive delta, we get longer, right? It means it's going to act like long options. So as the stock goes down, right, as the stock goes down, that positive delta is going to hurt us, right? Because negative stock movement times positive delta is negative movement in the options, right? Just like positive movement times a positive delta is a positive movement in the position value, an increase in the value. Okay, and we also have very, very small gamma. What does that mean? That means that the options are far enough out of the money that the way they respond net to a change in the stock price, the effect that they have on the delta is going to be very, very minimal. So we actually can hang on to this trade for a little bit longer for sure. And where it's I'm pretty confident that we should be able to get out of this for about a $90 $90 profit, which be fantastic. Now, let me show you why we did this on September 11th. Okay, let's go to the Amazon chart. I'll show you why we did this. Here is, let's just zoom in on September 11th, which is right over there. There's Monday right there, right in there. And if you notice something really, really interesting about this chart, after the earnings, the stock really got hit, and it was trading consistently below its 20-day moving average, which is the 21-day moving average, which is the white line, and it actually was closing below its trading below its 50-day moving average for a while as well. But over the towards the end of August, it stopped going down, and it actually came back pretty strongly off this bottom. Now, it went back above the short term, the 8-day, the 20-day, poked above the 50-day just for one day, couldn't really hold it, but what we saw happening at the same time was the stochastics were getting stronger and the MACD histogram was getting stronger. So things were telling us that under the surface, things were getting a little bit better. Now, as the stock went sideways, that was a hint that maybe the worst was over. And this new level here at 970 or 965, whatever that is, let's see, right down in here, the bottom, not the wicks, but the actual bottom of the candles down in this, let me get in there, that 965 area right there was starting to hold. Okay, on September 11th, when we had this little move up here on Monday, the stock was starting to trade above the shorter term moving averages. All the technicals were still in gear, but you know it's an expensive stock. It's a very high price stock. It's hard to trade this stock. So what are we going to do? What we have to do is we have to find a way to try to make money out of from our opinion. Well, what was our opinion? Well, my true opinion was that I thought the stock was going to go up. But in order to get away cheaply, in an expensive stock like this, you have to buy something like an out of the money bull call spread, pay $2-3 for something, and hopefully the stock will go up and you'll be able to sell the spread for $5 or whatever it is. Okay, but what's the other way to play it? The other way to play it is through the bull put spread. And what do we do with the bull put spread? We put the bull put spread below the stock, and we put the strike prices of the puts at a place where we don't think the stock is going to go. Why? Because if we sell a put spread, we have risk, we have exposure. So if we analyze our Amazon trade, and there it is, okay? Here's the stock at $9.99. Here's our short strike right here at 962.5. Let me get rid of this. You got to get right in there. 962.5 is where the put is. I don't know what that's doing over there. Let's get rid of this. Let's see, why is it looking like that? Anyway, you got the basic idea. We put the put spread below the market with $115 credit. Okay. It must be picking up something here, because here's the 962.5 right there. I don't know what this little thing is there. Anyway, the point is that when we traded when we put the trade on, the stock was over here. It was about 980. Hey, now you might say, oh, 962 and a half. Maybe that's a little close, right? That's only 18 points. But also remember, it's a September 22nd expiration. So what were we saying? We would collect $1.15. We would hold on to the trade for 2 weeks at most. What's our risk? $385. And that's only if the stock really, really tanked down here at expiration. If you notice before expiration, it's not the full loss. Why? Because the options retain extrinsic value. So what we were looking at is, hey, as long as we can keep the stock above 962 and a half by next Friday, the 22nd, we should be in great shape, and we'll make $115 on a $385 maximum risk. Okay, so that's what we put the stock. We put the trade on. The stock's right up here. If you notice, the P&L for today's line, which is the purple line, is starting to get closer and closer to the maximum profit line. And there's two ways that could happen. Okay, actually, there's three ways because it has sensitivity to volatility, but that's neither here nor there. At this point, there's two ways to focus on that, to look at this. Number one, time goes by, right? This purple line will eventually become this blue line. So if the stock now just sits here, right, here's where we started the trade, let's say. Okay, if the stock just sat there, eventually it loses the extrinsic value and the trade becomes 100% profitable. We get to keep all of the premium. The other way that you can make money is if the stock goes up, because as the stock goes up, the puts get further out of the money. But as long as there's time left, the P&L line is not going to be in the same place as the at expiration P&L line, right? So right now, because the stock went up, we have about an $80 profit, but only 3 days have gone by. Actually, yeah, 2.5 days have gone by, right? So we really haven't gotten a lot of the benefit of the theta, the positive theta, but we did get a big impact because of the movement in the stock. So you can make money one of two ways, right? You can make money by the stock going up. This is using the bull put spread. The stock going up, time passing, or a combination of both. Okay. You can also make money if the level of implied volatility goes down. That's because you're selling an option with a strike price that's closer to the stock price than the one you're buying. So you have some negative vega there, but that wasn't the intent of the trade. So far we're in pretty good shape, and as the stock goes up, we're actually building more and more of a cushion, because with a strike price of 962 and a half, all of a sudden our short strike is almost $38 out of the money. So we started with something that was about $18 out of the money, and now we got something that's $38 out of the money. So far that's working out just fine. So we're really, really pleased with that. Again, part of the game in this type of trading is you want to try to pick your spots. And that Amazon just seemed like a really good spot to put on that put credit spread. Okay, so what else we got going here? Okay, something else we did, and this is also in the course. It's not something you see a lot, but yesterday in Lowe's, what we did was, instead of buying the lower strike with a longer expiration and selling the higher strike with the shorter expiration, which is the very traditional standard call diagonal spread along the lines of, let's say, just look over here. Well, let's look at the Netflix since that's such a killer trade. It's going so great. See, we bought the October 180 and we sold the 182.5 call. Okay, in this one, we bought the higher strike and we sold the near-term lower strike. Now, it's going to have a very similar shape to the bullish construction of the call diagonal, but where the losses are going to look a little different. I'll explain it to you. Let me show you what we did here. So why did we do it that way? We did it that way because Lowe's is not a very volatile stock. The level of implied volatility is not super duper high. So if we look at this Lowe's trade right here, let's get over here. I'll look over here. Okay. Let me just go to the add simulated trades. You could see that the levels of implied volatility are pretty low. 19% here. What do we got here? 21% here. Okay, so these are not the 25s, the 30s, things that we might be used to in terms of getting a little more premium with our diagonals. However, it doesn't mean that you can't create something that has some real potential, because as we know, one of the main thrusts of the diagonal spread is to try to collect premium along the way so that you can lower the cost of the trade. Okay, so what we did here was when we started this, you could see we actually started this with the 79.5 call at 69 cents and the 80 call at $2.13 right there. So our net cost for this trade was only $1.44. Now, because the short strike is slightly lower than the long strike, the way this is going to look is a little different. And I don't know if you can really see this, but if you notice, there's a little more risk on the upside than there is on the downside. And that's because, in truth, we are short a 50-cent call spread here. So if this stock were to run way up without us doing anything, we would end up not only losing our premium, the $1.44, but the extra 50 cents. Over here, if the stock got pummeled, the worst thing that could happen is we would only lose the $1.44. But on this side, because we also have that short 50 cent spread, we can lose the extra 50 cents. Am I worried about it? No, I'm not worried about it, because the stock is over here at 77.84. And what we're looking at is the potential that if the stock moves into this area, 79.80, 79.580, we could actually have a very nice profit in a very short period of time. That's about an $80 profit on $1.44, with, as usual, the potential to roll that option that expires next Friday, or just keep the November 80 call at a net cost of $1.44. That's sort of the situation that we have in the Schlumberger, right? Our net cost for that Schlumberger call now was only $2.66, even though we paid, I think, over $3 for the call by itself. Our net cost is only $2.66 because we've taken in the premium. So in this construction, what you're doing is you're still creating the diagonal, but you're moving the risk over, little extra risk over to this side of the trade. In this case, it's not that big of a deal, but I did decide to sell the 79.5 instead of the 80 to create the calendar spread because I was getting more premium for the 79.5. And with the stock, 78 or so, where was the stock today? Down 80 cents. So, with the stock 78.5 or so, and today's high 79.43, I really felt that there'd be plenty of time to roll that 79.5 up and out and move with the stock if the stock started going up. So I figured, why don't I just capture that extra premium in the 79.5, get the cost down to $1.44, and as I like to say, Scarlett O'Hara, I'll worry about it tomorrow. Okay, so that's why we did this one like that, and why Lowe's and not Home Depot? Well, people might say, hey, don't do anything. Don't do anything because all the hurricanes are over and all of the emergencies and all the emotion is going to be out, right? But I'm looking at this chart and I'm looking at a very, very strong double bottom. Stock is now trading above the short term and the 50-day moving average with the 8-day above the 21-day. The stochastics are nice and high. The MACD histogram is good. We like when the directional movement indicator, the DMI, is also positive when the green's above the red. So this looks like all we need is a push, right, to 79.5, and we're in great shape. So why do Lowe's instead of Home Depot? Well, maybe I like that's why I rent from Avis, right? We try harder, right? Well, look, Home Depot's already made the move, right? That's the one everybody favors, right? When you think of it, you think of Lowe's. When you think of that business, when you think of that business, you think of Home Depot. You don't think of Lowe's. But I think that Lowe's is offering us a much better opportunity here than Home Depot. If you just look at the chart, this has still got some upside here after putting in a very nice double bottom, and the momentum seems to be in its way, in its favor, not in its way. The wind is at its back here. So that's why we did the Lows that way. We did the trade on the 12th, which was yesterday, right in here. And we're going to be long that 80 call for $1.44. And believe me, we will be able to collect premium along the way because we are long the November 80, just like we're long the November 67.5 in the Schlumberger. All right. Let me take a sip. Okay, finally tonight, what I want to review with you is a very, very special type of position management in diagonals, and it's something that you can use for any position, any long position that's going in your favor. Okay, it has to do with something called rolling up your call or rolling down your put. And what that means is you stay in the same expiration and you take money off the table by rolling up your call to the next strike price if the stock's going up, or if you want to put in the stock's going down, you lower the strike price and you take money out by, in effect, selling the credit spread. Let me give you an example. Okay, here's the sell gene. Okay, we started this trade back on August 30th for a $6.30 net cost. Right now, our net cost is $5.55. But what's our problem? Our problem is that we're long the October 130 and we're short this Friday's 135. The stock is 141 short this Friday's 135. The stock is 141. And the spread itself is only trading at about $5.90. So the trade itself, even though we were incredibly right on the stock has really moved too far too fast. And that happens to be one of the things about diagonal spreads that you got to watch out for. So we did the trade on October 30th, which is right there, right on that break. You see, we try to be very consistent. We're above the 50. We're above the other moving averages. The stochastic is positive. The MACD histogram is positive. The DMI is positive. So what do? We go in, we buy the October 130, we sell the 135 up against this resistance here, and the stock just blows right through it. Okay, I can't control that. I can only control what I do in response to it. So for the next 2 weeks, all I did was roll out to the next 135. And each time I actually collected enough premium to get the cost of this thing down to 555. Okay. Unfortunately, it's not enough premium to make this exciting. Okay. If this thing is $5.90, barely, it only has about 35 cents of profit in it, which sort of seems like a waste. Okay. So what do? Okay. Well, here's something that you really want to watch. You really want to watch me do this, because this is going to show you the power of understanding option price behavior and using the simulation tools. Okay. So let's go over here. We're going to go to add simulated trades. We're going to go back to our cell gene. Okay. And we're going to go to our September 135 call. You could see it's trading at 640. Now, if we wanted to roll to next week's 135, it looks like we would take in another 20 some odd cents. All right, that's great, right? We get another 20 cents out of it, but we're still stuck with that same $5 call spread. Okay. So what are some of the things we can do to try to make our lives better? Try to squeeze out more profit out of this trade. Well, the first thing we're going to do is we're going to roll up the 130 call, because that in effect will take money off the table. It will actually lower the risk of the trade. Okay. And how do you roll up? The way you roll up is you sell the option you own and you turn around and you buy the next highest strike. Okay. Now, in this case, we are rolling up. We're considering rolling up by $5 from the 130 to the 135. The rule of thumb with rolling up calls or rolling down puts is you want to capture at least 80% of the distance that you're rolling. Because remember, if I'm rolling up 5 and I'm not collecting 5, I'm leaving some money on the table, right? So if I'm rolling up 5, but I'm only collecting 4, I'm actually leaving $1 on the table. Okay. So we're going to start with this. So this roll right now is going to bring in a $4 credit. Now, the actual net cost to us, I said, is $5.55. So if we have a net cost right now of $5.50, $5.55, and we roll up and we take $4 out, then our net cost is only going to be $1.55. Well, this right here, unfortunately, since the system only tells us where we're at right now, you could see this is only $1.05 right here. right in here. This is only $1.05 right there. So we have to adjust this credit here so that our net cost is $1.55. So if we have a cost of $1.05, how do we get our cost to $1.55? Well, the way we're going to do that is we actually have to do this for a debit. I know it's weird, but we have to do this for a debit of 50 cents. Okay? Why? Because we have to get the net cost of this trade down to this whole trade down to $1.55. You just got to trust me on this. Okay, so what I'm doing is I'm adjusting the roll to reflect the new net cost of the entire trade, which would be $1.55. Now let's just see what that looks like. Okay, so this is just rolling the 130 call to the 135 call. Let's look at that risk profile. Okay, and that's what the trade is actually going to look like on September. Let's go to the second expiration. Hold on. No, I'm sorry. This is still correct. If we did this right now, this is what the trade would look like on Friday. Okay, on Friday. It looks like a very traditional calendar spread where if the stock were to get back to 135, we've got a killer trade. We're making 250 bucks. But we got a problem. The problem is the stock's not anywhere near there. The stock is over here, right? The stock's over here. So it's not going to help us, right? It's really not going to help us. Look, if the stock keeps going up, what good is it that we took out that $1.50? The stock keeps going up. We're actually going to keep losing money. So that's not going to work. So what do we have to do? What we have to do is we also want to roll up. Let me make this $4. Let's get this back to $4. Okay. What we want to do is we want to do something with this option that we're short and see if we can roll that option out to next week to see if we can improve our position. Okay, so let's just do something. We'll just pick something at random. Let's buy back our 135 and let's sell a 137 call. Okay, so we're going to move our long strike up by 5, but we're only going to move our short strike up by 2. Okay? So what is that going to give us? Let's rebuild it. We're going to buy this back at 655. We're going to sell this at 480. And then we're going to go back over here and we're going to sell this. And we're going to buy this. And of course, we're going to do it all on a one lot basis since we're doing this in our educational account. So we don't tell you, we don't make any determinations in terms of size. And you can see that this is going to give us a $2.60 credit. Okay, so a $2.60 credit off of our $5.55 cost gets us down to $2.95. Okay, so now our cost is $2.95. How do we get our cost down to $2.95? We have to make this minus $1.90. And that gets us $1.05, and $1.90 gets us down to $2.95. Let's see what that looks like. And let's go to the second expiration because now we're looking over there. And there you go. Okay, now things look a little different for next week. Okay. Our net risk now is only $295. God forbid something happens. We still don't have a lot of room on the upside here. We don't have a lot of upside room here, but at least we'll be able to maybe roll that 137 call out. But look, if the stock now goes back to 137 next Friday, we will have a profit of $164. Right? What is that? $169. Right? Because what happened is we took risk off the table. Right? We took $260 of risk out of the trade. So now we've got some breathing room. We have some time to be able to work out the trade. If the stock keeps going up, we'll have to worry about it again. Okay? But what have I done? I've done two things. I've lowered the risk of the trade to 265, and I've changed the strike price, the short strike, from 135 to 137, right? To 137. Now, obviously, this is not correct because it's doing off of that $1.05. So this is actually $450. $450 less. That's why I said we're only going to have about a $30 profit right there. Okay. But it does change the dynamic of the trade because I took out premium by rolling up and I increased the strike price of the short. So now I can still make some very good money and I don't need the stock to back off as much. But as I said, if the stock keeps going up, I'm going to have to deal with it. But the truth of the matter is that in this case, by moving this up a couple of bucks, I now put myself in a situation where I have an extra week and I have that higher strike price. If I did not do that, if all I did was roll the option up, if all I did was roll the option out to next week, look what would happen. I would only collect an extra 28 cents. That would get my risk down from 555 to 527. So this is actually $4.22. And now you'll see what this looks like. We go back here to the second expiration. And you see down at 137, not making nearly as much money. I need the stock to go back here. And if the stock keeps going up, I'm still in the same predicament that I am before. And if the stock starts going back down, I still have that extra risk, right? Because now my risk is still $5.27. So at this point, it doesn't seem to make sense to actually roll from the 135 to the 135. What really seems to make sense is to explore, and I'll be doing this tomorrow, and I'll report on it on Monday. I'm going to explore tomorrow these other types of rolls and then let everybody know what decision was made and why that decision was made. Okay? So from the point of view of what's going on here, we're really happy with the way the educational portfolio is going. We've been at this for a couple of months. We're starting to compile some results here to show folks exactly how to implement what's in the course. You know, you can always email me, Elliot@investingshortcuts.com, and we're going to be publishing. I think we're going to be giving folks access to some of these results, just to show you the history of the trades, uh, really, really soon. So anyway, we appreciate your attention. Hope you're getting a lot out of these discussions. It's nice to see the market maybe showing some semblance of normalcy again. And good luck to everybody. And just keep practicing. Just keep practicing, putting trades together and doing your analysis. Hey, everybody, have a great week, and I'll see you next Monday.